So there's still people out there, mostly insurance salesmen and non-fiduciary advisors, who insist that single premium immediate annuities are a good choice for senior citizens, or that they are somehow some sort of bread and butter part of every senior's portfolio. And when they defend SPIAs, they never actually crunch the numbers to prove their point. They just generalize. For example, they'll talk about the stock market decline from 2000 to 2003 or the 2008 market crash. What they conveniently ignore is the most elementary rule of investing: diversification. You don't just invest in stocks, you invest in bonds too. And when stocks crash, money runs to the safety of bonds. Now, since the year 2000, we've been through times of recession and some of the worst financial markets. And most people would agree, if ever there was a time period in which a SPIA might do well, it would be in the last 14 years. But what if I told you that from January 1st, 2000 until January 1st, 2014, with an age-appropriate mix of 75% Barclays U.S. Aggregate Bond Index and 25% S&P 500 stocks, and a simple rebalancing strategy, you would have not only gotten the same exact yearly payments that you would have gotten from the best SPIA out there, but generally still had your original principal. And thus, after 14 years, there was no point in sacrificing your principal to the insurance company, and no point in sacrificing your liquidity, meaning the ability to get your money back at any time. And remember, the premise for locking your money up in a SPIA is you don't want your principal to run down to zero before you die. And the assumption is that during the lost decade from 2000 to 2010, people's money ran down to zero and they had to go back to work in their retirement years. But as you can see in this chart, over the last 14 years with a 75-25 portfolio, that didn't happen. Now, I should disclose that there's two things that I haven't accounted for in this study that both help and hurt the 75-25 portfolio. Number one, annuities are taxed at a higher rate than this 75-25 portfolio. And you can see in this chart that with normal investments, you incur lower taxes and may not pay any taxes at all. And number two, I haven't calculated the fees associated with buying, selling, and owning low-cost ETFs. So you figure after 14 years, your account is still probably around the $100,000 range. You're 14 years closer to that finish line when you check out of this world, and you still haven't lost your original principal. And this is while taking out 5.5% per year, which is 1.5% more than the 4% that they were recommending back in the year 2000. So the 75-25 portfolio held up while taking out too much and held up during times of recession. And by not forfeiting your money to an insurance company, your heirs would be poised to inherit 100% of that money if you were to die. Now, there's an article in Forbes Magazine called "The False Promises of Annuities and Annuity Calculators," and I decided to crunch my own numbers based on the same couple, aged 62 and 64, who had $500,000 to invest, only for simplicity, I made it $100,000. And if you read the article, the best price quote this author found for a SPIA had a payout rate of $27,569 per year. Divide that by 5 for my example, and that's $5,513.80 paid per year, or 5.51%. So if a SPIA pays 5.51%, you can do the math. For the first 18 years, the insurance company is simply giving you back your original money. So if this senior citizen couple happened to die at age 80 and 82, after 18 years, their return on investment would be 0, not 5.51%. Because remember, your original principal is gone. You stupidly gave it to the insurance company. And this compares with a traditional 75-25 portfolio, which had a return of 4.5% after just 14 years. That's about $100,000 of inheritance money that you gave to the insurance company because of your paranoia about stock market volatility. Now let's say this couple lived 25 years to the ripe old ages of 87 and age 89. In this case, they would have received a total of $137,845 in payments, and of course their $100,000 principal would be gone, so their actual return on investment would be 1.3%. Now let's say this couple lived 35 years to the ripe old ages of 97 and 99. Very unlikely, but in this case, they would have received a total of $192,983 in payments, and their $100,000 principal would be gone. So that means that their return on investment would be 1.9%. Still absolutely pathetic. Anyway, the other point this author made is that after 20, 25, 30 years, the purchasing power of those fixed 5.5% payments will have declined significantly due to inflation. For example, after 23 years, $100,000 in 1989 only had the purchasing power of $54,000 in 2012. So it's almost been cut in half in 23 years. So if you choose to accept one single fixed payout rate for the rest of your life, what does that really guarantee? Poverty? Fixed payments become unsustainable due to inflation. Now another thing, you can't rebalance a SPIA because your money is permanently stuck in that ultra-conservative financial product. And rebalancing is a simple, basic strategy that investors use to control risk by keeping their portfolio properly diversified, and at the same time, this can increase your returns. For example, you can decide that if and when the stock portion of your 75-25 portfolio becomes out of balance by a certain percentage, such as 50% one way or the other, that would be down to 12.5% or up to 37.5% from 25. If this happens, you will then spring into action and reset it back to 75-25. And in fact, in 2009, stocks actually dropped as low as 56% from their highest peak, and for about 9 months, you had the opportunity of a lifetime to shift some of your conservative bond money into your aggressive S&P 500 stock investments at a fire sale. Then you were poised to earn greater returns. Now for my study, I'm only looking at 1-year intervals on January 1st. So on January 1st, 2009, the 25% stake in stocks had dropped below that 50% out of balance point, and what was supposed to be 25% in stocks had suddenly become less than 10%. So this sticks out like a sore thumb. The portfolio had become completely out of whack. Now conversely, when stocks soar up in value and bonds lag, you can shift money back into bonds. In fact, at the end of this 14-year time period, this portfolio was starting to take on too much risk. As you can see, the stock portion was starting to represent more than 37.5% of the total portfolio. So in conclusion, by being a coward and putting your money in a SPIA, which is advertised as protection so that you won't run out of money, by the time you get to be in your 80s and 90s, are those payments really going to be enough when we adjust for inflation? And are you really going to run out of money in the first place if you just invest in stock and bond ETFs? Well, over the last 14 years, that obviously hasn't happened. And keep in mind that I selected a starting point, the year 2000, when the 1990s bull market ended. Is your timing really going to be this bad? Bottom line is that a SPIA is not what it appears, and you really ought to consider an age-appropriate portfolio that fits your appetite for risk. And as they say, never bear too much risk or too little risk. You might decide that with a SPIA you are bearing way too little risk. Be safe with your money, and this video does not constitute personalized advice to buy, sell, or trade securities.